Welcome back to the deep dive. So for years, we've all been watching it happen, right? The national debt keeps climbing, inflation is just relentless, and all the signals are pointing to one thing.
Extreme fiscal stress.
Exactly. And we know a lot of you listening are preparing for what that means. Historically, it always means one thing.
Taxes, they have to go vertical.
And when that realization really sinks in, you see the smart money, the wealth that can actually move, start to look for the emergency exit.
It's the ultimate backup plan. Leaving. Renouncing your ties, maybe finding a more stable, lower tax place to protect what you've built. And look, this isn't about patriotism, not really. It's a cold, hard assessment of financial risk.
It's that mental safety valve, isn't it? The belief that you have a right to leave, to take your capital that you worked a lifetime for, and find better stewardship for it somewhere else. But our forensic investigation, our deep dive into the U.S. tax code, it reveals something pretty shocking. A mechanism that just shatters that whole illusion of freedom.
Government saw this coming. They anticipated the move.
They did. And they didn't build a concrete wall to keep your money in.
No, nothing so obvious. They built an invisible one. One made of incredibly complex, punitive legislation.
And it's engineered to capture your wealth at the exact moment you try to leave.
It's like that line, that really chilling line from the song Hotel California.
You can check out anytime you like.
But you can never leave. That's it. We are talking about the U.S. tax code, specifically IRC Section 877A.
And this isn't just some administrative process. It's a financial tripwire. It's designed, really, to confiscate a huge piece of your net worth if you try to cross that invisible line.
So our mission on this deep dive is to open the files on Section 877A. And we need to be clear from the start, this is a shock. If you try to cross this wall with your wealth, you trigger the exit tax.
You have to buy your freedom back.
At a price designed to be financially crippling. This is, well, it's a form of financial prisondom.
Okay, let's unpack that, the core mechanism. Because it's not a simple tax. It's based on what the IRS calls a legal fiction.
That's a good way to put it.
So if I'm a U.S. citizen and I decide to renounce, I'm expecting to file my last tax return, pay what I owe for the year, and that's it.
Right, that's what you'd think. But instead, they hit you with this concept of a deemed disposition.
A deemed disposition? What is that in plain English?
It's the engine of Section 877A, and it is an aggressive piece of legal work. The law says that if you're a covered expatriate, and we'll get to what that means, the IRS gets to pretend.
Pretend.
They operate under a legal fiction. They pretend you sold every single asset you own worldwide on the day before you officially renounce.
Wait. So my house in London, my stocks in a Swiss account, maybe gold I have stored in Singapore.
All of it.
The IRS just acts as if I sold it all for cash that morning.
That is the fiction, precisely. It's universal, all your worldwide assets, and it's not just the easy stuff like stocks and crypto.
Oh, this is where it gets bad, isn't it?
This is where the nightmare begins. It captures the illiquid assets, your equity in a private family business, intellectual property, art, collectibles, even your 401k and foreign pensions.
Wow. Okay, let's pause right there because the illiquid part is key. But first, how do they calculate the tax bill if nothing was actually sold?
They calculate what's called a phantom profit.
Phantom profit.
It's the difference between what you originally paid for the asset, your cost basis, and its fair market value on the day before you leave.
So the unrealized gain.
The unrealized gain. And you are sent a bill immediately for capital gains tax on that phantom profit. You are being taxed on money you haven't actually received.
There has to be an exemption, though. I mean, they can't tax the first dollar of gain, can they?
You're right, there is. And this is a really critical detail. There's a statutory exclusion. For 2024, it's around $850,000.
Okay, so a little bit of relief.
A little. So the first $850,000 of your total phantom gains across all assets is excluded.
So if my total unrealized gain is, say, $1.5 million, I subtract the $850, and I pay tax on what's left.
That's the math, yes. But remember, it's cumulative, not per asset. And if your gains are substantially over that, you're paying a high capital gains rate. Could be almost 24% on the rest.
Let's go back to the illiquid assets, because this is where it stops being a tax and starts feeling like confiscation.
It is.
So take a classic example. An entrepreneur built a business from nothing over 30 years. Her cost basis is basically zero.
Right.
On the day she renounces, the business is valued at, let's say, $15 million. She suddenly has a $14 million phantom gain minus the exclusion.
She now owes millions of dollars. in cash, immediately.
But the asset is a company. It's not for sale. It's brick and mortar.
And that's the liquidity nightmare in its purest form. She has maybe a $3 million cash tax bill, but her net worth is tied up in her business.
So what does she do?
She have to find that cash. It forces a fire sale of whatever liquid assets she has, or she's forced to take on massive debt against the business itself just to pay the government.
So the mechanism is designed to bankrupt you, or at least severely weaken you, before you even get to the airport.
It diminishes your wealth before you can ever leave the U.S. tax system.
I've heard you can defer the payment, though. Is that a real option?
It's far from simple. You can elect to defer, but you have to post security. Collateral.
What kind of collateral?
An irrevocable letter of credit. Or the government just puts a lien on the assets themselves, and, of course, interest starts piling up on the deferred amount.
So you're taking out a forced, interest-bearing loan from the government.
Guaranteed by your own assets.
Just to pay a tax on money you haven't even made yet.
It adds another layer of legal and administrative cost. It's all designed to create friction.
And we haven't even defined who this applies to. Who is a covered expatriate? It's not just citizens, is it?
No, and this is so critical. There are 3 tests, and you only need to fail one of them.
Okay.
1, the net worth test. This is the big one we'll dive into. If your net worth is $2 million or more.
$2 million.
2, the tax liability test. If your average income tax bill for the last 5 years was over a certain amount, around $200,000 for 2024.
Okay.
And 3, this one's a killer, the certification test. You fail if you can't certify under penalty of perjury that you've been fully compliant with all U.S. tax obligations for the past 5 years.
Wait a second. The certification test.
Yeah.
So if I just made an administrative error, I missed filing a foreign bank account report, an FBAR, 4 years ago.
You're in.
I could be automatically labeled a covered expatriate, even if my net worth is way below $2 million.
That's absolutely right. It's a blunt instrument. And a lot of people living abroad have complex finances. It's easy to miss one of the dozens of required international forms.
So it's a trap not just for the wealthy, but for the administratively imperfect.
Exactly. This whole thing, Section 877A, it's not just about collecting revenue. It's about making the act of leaving so painful, so expensive, so legally risky
That you just don't do it.
It's a deterrent. The cage is built of complexity and the fear of a tax on the theoretical. And this brings us to the part of our investigation that, frankly, should worry every successful middle-class American.
Because everyone hears this and thinks, okay, this is for billionaires. I have a house, a 401k. This doesn't apply to me.
And that is the most dangerous assumption you can make right now. We have to be crystal clear. The net worth test threshold is $2 million, and that number is fixed.
What's so important about it being fixed?
Oh, we have to look at the history. This law, 877A, was passed in 2008.
Okay.
Back in 2008, $2 million. I mean, that was a lot of money. It was a high net worth figure. The law was aimed at, tech billionaires cashing out.
But fast forward to today. What does $2 million look like now? In a major city on one of the coasts?
It's a completely different world. $2 million today. That's the profile of a successful middle-class life.
Give us an example.
Okay, think about a couple in their late 50s. They bought a house in Boston or San Diego 30 years ago. It's paid off. It's now worth, $1.2 million?
Easily.
They did the right thing. They saved diligently in their 401k. It's grown, maybe it's at $700,000 now. Add in another $100,000 in savings.
And there you are, $2 million.
Right there. They are now officially classified as rich by the IRS for the purpose of this one specific tax.
And this is the core injustice. the twisted genius of it. That $2 million number is not indexed to inflation.
And non-indexing, that's the weapon. That's what we call the inflation trap.
A financial pincer movement.
Exactly. Let's break down what's happened since 2008. The Federal Reserve has, dramatically expanded the money supply.
Right. Quantitative easing, deficit spending.
And what does that do? It devalues the dollar. That's monetary inflation.
Okay.
So as the dollar's purchasing power gets systematically destroyed, what happens to the price of real things?
It goes up. The nominal price.
Mm-hmm. Right. The dollar price of your house, of gold, of solid blue chip stocks. It shoots up. Those assets are just holding their real value, but the unit of account, the dollar, is getting weaker.
So that house they bought for $200,000 in 1995 is now worth $1.5 million. And the IRS looks at that $1.3 million gain.
That phantom profit.
And says, you are a millionaire. You are over the threshold. Welcome to the trap.
The government's own inflationary policies are the very thing pushing ordinary people into the category of covered expatriate.
So you're not actually getting richer in real terms. Your dollar's just getting weaker.
But the IRS doesn't care about real terms for this. The very policy that destroys your savings is the same force that pushes you into the exit tax cage.
And that creates this brutal lock-in effect.
It's terrible. That couple we talked about, they suddenly realized their house appreciation pushed them over the line. Now if they want to leave, they're facing a massive phantom gain on their primary residence.
They could owe hundreds of thousands in cash tax just to leave the country.
And usually they realize this way too late. They're already trapped. They either have to stay in a system they think is unstable, or they pay a huge ransom to get out.
They're being punished for being responsible, for owning assets that beat inflation.
Think about this. If that $2 million threshold had just been indexed to inflation since 2008, what would it be today?
Probably closer to 3 million, maybe 2.8.
At least. That gap between the static $2 million and what it should be, that's the size of the dragnet that's been cast over the middle class.
So this is an urgent warning then, for anyone sitting on a net worth of, say, 1.5 to 2.5 million.
The door is closing. And it's closing fast. Every single quarter of high inflation pushes more hardworking people over that line. Timing your exit isn't about the market anymore.
It's about escaping the dragnet before you're reclassified as rich. Okay, so let's shift gears. Let's say a listener hears all this and thinks, fine, I won't renounce, I'll just move abroad and start moving my assets physically.
The second layer of the invisible wall.
This is where a whole different set of tripwires gets activated, right? At the actual border crossing.
Exactly. A lot of people, and it makes sense, they don't trust banks, they don't trust digital systems, so they choose to transport physical wealth.
Gold coins, cash, things like that.
And that choice puts you immediately under the microscope of Customs and Border Protection, CBP, and FinCEN.
And the magic number here is $10,000. You have to explain this requirement.
Right. If you are moving more than $10,000 worth of what they call monetary instruments across the border, you are legally required to declare it.
How do you do that?
You have to file a specific form, FinCEN Form 105.
And what exactly is a monetary instrument? It's not just a stack of cash, is it?
Oh, it's much broader than that. It's cash, traveler's checks, money orders, sure. But it's also any negotiable instrument in bearer form.
And critically for our listeners,
critically, it includes investment-grade gold coins and bullion. So if you're carrying a handful of gold eagles or Krugerrands, you're over that $10,000 limit very, very quickly.
So you file the form. You're being honest. You've complied with the law, but you've also just done something else, haven't you?
You have. You've put a massive red flag on yourself. You're now in a federal database flagged as someone moving significant wealth across a border.
But the real danger isn't the form. It's what can happen next.
The real danger is seizure. The moment you declare that wealth, or worse, if you don't declare it and they find it, you activate the threat of civil asset forfeiture.
And this is a wild legal concept.
It's profoundly aggressive. It allows a CBP officer to seize your wealth on the spot if they have probable cause to suspect it's related to a crime.
But what kind of crime? If I have the receipt for the gold I bought, I'm obviously not a narco-trafficker.
And that's what makes it so terrifying. The suspicion can be incredibly broad. They could suspect structuring, trying to avoid the reporting requirement,
Right.
Or, more likely, they can just suspect you're trying to evade taxes. The mere suspicion is enough.
The legal technicality here is what always gets me. The government doesn't charge you. They charge the money itself.
It's an old maritime law concept called in rem. The legal action is against the thing, not the person. So the lawsuit is titled something like United States versus $50,000 in U.S. currency.
Or United States versus 40 gold coins.
Exactly. The asset is the defendant. And under these statutes, the asset is presumed guilty until proven innocent.
And that flips the whole legal system on its head. The burden of proof is now on me, the traveler.
Yes. From a foreign country, you now have to prove your money's innocence.
What does that even look like? How do you fight that?
It's a nightmare. You have to hire expensive U.S. lawyers. You have to provide a perfect paper trail for the source of the funds, prove all taxes were paid. It's a long, expensive battle.
And the legal fees can just eat up the value of what was seized.
That's the game. If they seize $50,000 in gold and it costs you $30,000 in legal fees to maybe get it back, who's really won?
The government.
They almost always win. They'll often offer to give you back, say, half for 75% if you just drop the case. They get free revenue and you cut your losses.
So trying to move physical wealth across the border today is it's high-stakes gambling.
Even if you are completely innocent and you file all the right forms, it's a backup capital control. If the exit tax doesn't get you on paper, civil forfeiture is waiting at the airport to get you in person. So our investigation can't just look at the laws, we have to look at the signals, at the behavior.
Right. What is the government signaling through its actions, through its pricing?
And when you see demand for something exploding and the provider, in this case, the government jacks up the price, it tells you something.
They're trying to slow it down. They're throttling the exit.
Precisely. And the clearest signal of this is the cost to formally renounce your U.S. citizenship. Let's just look at the history of that fee.
For years it was, almost nothing.
For a long time, it was free, or a nominal fee, maybe $50. Then, as things got more volatile, they raised it to $450.
Okay, $450. An administrative fee? Annoying, but not prohibitive.
Right. But then came the spike.
The big one.
All of a sudden, with very little justification, the State Department raised the fee from $450 to $2,350.
Wow. From $450 to $2,350.
That's a 422% increase in one move.
That's not an administrative cost adjustment. There is no paperwork in the world that justifies that kind of price hike.
Of course not. It's a policy statement.
What's the statement?
The statement is, demand for exit is skyrocketing, and we're going to use price as a tool to create friction. That fee is now the highest in the entire world for renouncing citizenship.
Highest in the world.
By far. Most developed nations charge next to nothing. This sets the U.S. apart as a country that is actively discouraging people from leaving.
So they see the smart money running for the doors, and they're monetizing the escape route.
And discouraging the stampede at the same time. The State Department is acting like a monopoly provider during a bank run. They know people are worried enough to give up a U.S. passport, and they figure those people are willing to pay almost anything.
And the friction isn't just the price tag, it's also the delays, right?
Yes, there's a direct link. As the fee went up, the backlogs grew. It's now incredibly difficult to even get a renunciation appointment at a U.S. embassy.
You have to make an appointment to quit.
You do. And the wait times can be months, sometimes over a year in certain places.
So this combination, the extreme cost and the long delays, we're calling this soft capital controls.
That's exactly what it is. Look, hard capital controls are what China does, an outright ban. Soft controls are more insidious. You use high prices, bureaucracy, and delays to create friction.
You make the process annoying, expensive, and slow.
You throttle the exit, it buys the government time, it slows down a capital flight without causing a full-blown panic.
So it serves two purposes. It squeezes one last bit of revenue out of the people who are leaving,
treating them as a final source of profit.
and it scares off the people who are just thinking about it.
Yeah.
It makes the door seem very narrow and very expensive.
And it confirms our entire thesis. For anyone watching the debt and planning their future, the window to act has never been narrower. The government is actively and aggressively raising the price of freedom. So when we put all the pieces of our investigation together, we come to one really urgent conclusion.
Timing is everything.
Everything. For anyone listening who gets the danger of this inflation trap, you have to act before your net worth crosses that static $2 million line.
Because once you're a covered expatriate, the trap snaps shut. You have to pay the tax. There's no way around it.
So if you're below or even just approaching that line, you need a plan, a legally sound playbook to position your assets internationally before you start the process.
And we've identified 3 critical strategies, things that have to be done beforehand.
Okay, the first one deals with that physical barrier. We're calling it the pre-exit vault.
So this is about the civil asset forfeiture risk.
Exactly. You cannot risk carrying your gold across the border. It's just too dangerous now. The move has to happen before you do.
So you instruct your broker or custodian to move the physical asset
to a private non-bank vault in a safe jurisdiction. Singapore, Zurich, Hong Kong, somewhere outside of direct U.S. control.
You move the asset well before you move. So when you get to the airport, you're carrying less than $10,000 and your wealth is already safe somewhere else.
The separation happens first. That's key.
Okay, strategy number 2. This one is administrative, but you can't skip it. Securing the second passport.
Or at least a long-term residency. This is non-negotiable. Because under U.S. law, you cannot renounce your citizenship if it makes you stateless. The State Department just won't process the paperwork.
So you have to prove you have a landing pad.
You have to show them you have citizenship or confirmed residency somewhere else, whether that's through an investment program in St. Kitts or getting residency in Portugal. You need that proof in hand before you even call the U.S. Embassy.
Or the whole process is dead on arrival.
Correct.
Okay, and the third strategy. This one is for the people hovering right around that $2 million line.
Right.
the ones caught in the inflation trap.
This is the gift strategy, and it's a sophisticated, time-sensitive way to legally lower your net worth before you trigger the tax.
How does it work?
It's about using the U.S. gift tax exemptions. If your net worth is, say, $2.2 million, you need to legally transfer at least $200,000 worth of assets out of your name before the renunciation date.
And who can you gift to?
Well, the easiest path is to a U.S. citizen spouse, using the unlimited marital deduction. But if your spouse isn't a U.S. citizen, that's much more restricted.
What about kids? Or a trust?
You can use the annual gift exclusion for kids, but that's a small amount.
Yeah.
To move a large sum, you'd have to dip into your lifetime gift tax exemption. The key is that the gift has to be real, it has to be irrevocable, and the timing is absolutely critical.
Because the IRS has a way to fight this, right?
The step transaction doctrine. They're not stupid. They know people do this.
So what is that?
If you gift the assets on a Monday and show up to renounce on Tuesday, the IRS will argue that it was all one integrated plan done solely to evade the exit tax.
And if they win that argument?
They ignore the gift, they pull those assets right back into your net worth calculation, and boom, you're a covered expatriate.
So the gift has to be done well in advance. Months.
At least. And it needs to stand on its own as a legitimate financial decision, not just a prelude to leaving.
So all of this, I mean, the complexity of the planning is itself a huge barrier.
It is. These are not DIY strategies. This proves the whole point. Leaving the U.S. tax system is a strategic battle. You have to recognize that the government views the citizen not as a partner,
But as a tax cow.
a tax cow. And the exit tax is the farmer demanding one last huge pail of milk before he'll let you out of the gate.
Any illusion that you could just build your wealth and walk away, this whole investigation shows that that's just not reality anymore.
And that forces every single listener who's been successful, who's been paying attention, to face a really difficult choice, a philosophical choice, really.
It's the ultimate debate, isn't it? As the risk keeps climbing here at home, you have two options.
You can stay and pay. You accept rising taxes, more complexity, maybe even hard capital controls down the road.
Ugh.
Or you leave and pay the toll. You renounce. You take the massive, immediate hit from the exit tax on your phantom gains.
The provocative thought we want to leave you with is this. What is the exit tax, fundamentally? Is it a fair share? One last payment for having benefited from the system?
Or is it a ransom? An extortion fee demanded by a broke government for your basic freedom to move yourself and your capital.
Think about your own situation, your own net worth relative to that $2 million line. If you got hit with that 7-figure phantom tax bill, would you do it? Would you renounce your citizenship to protect the rest of your wealth from whatever comes next?
Is that 70% you get to keep worth the price of your passport?
And finally, look at the signals. The 422% fee hike, the backlogs, the seizures at the border. Do you really believe these are just temporary things?
Or are they the setup, the necessary first steps before the U.S. implements full, hard capital controls and just bans money from leaving entirely?
The future belongs to those whose capital is free to move.
But that freedom, as we've laid out today, now comes with a very clear, non-negotiable price tag. And that price is going up every year that inflation keeps chipping away at the dollar.
We'd urge you to assess your own position relative to that $2 million line, and to do it now.